The trust fund recovery penalty is a penalty that the IRS assesses against certain individuals whom the IRS considers to be responsible persons, whom the IRS believes willfully failed to collect and or remit certain payroll taxes to the federal government. If that doesn't make sense, don't worry, but do buckle up, because this video is going to be the most comprehensive education on the trust fund recovery penalty you can find online. I guarantee it. And because this video is going to be so lengthy and in-depth, I'm going to give you an outline first of what I'm going to talk about before we actually get in to the meat of the video itself. So first of all, I'm going to talk about why is the trust fund recovery penalty called the trust fund recovery penalty? What is the trust fund? Why is it called trust fund recovery penalty? And as a part of that, I'm going to explain which payroll taxes can be part of the trust fund recovery penalty and which aren't, and why. I'm going to talk about how much is the trust fund recovery penalty. I'm going to talk about who can be assessed the trust fund recovery penalty as kind of a subset to that, who is a responsible person, and what does it mean to be willful in the context of the trust fund recovery penalty. I'm going to talk about, can a sole proprietor be assessed the trust fund recovery penalty, and why that's a natural question will hopefully become apparent over the course of this video. Then I'm going to talk about how the IRS assesses the trust fund recovery penalty. I'm going to talk about the Form 4180 interview. I'll explain what that is when I get there. And then finally, I'm going to wrap up with talking about what to do if you've been assessed the trust fund recovery penalty. Okay, so a lot of stuff in here. Please follow along as best you can. If you do so, you will be rewarded, I guarantee it, by the end of this video, of knowing more about what the heck the trust fund recovery penalty is than the average licensed tax professional out there today. I guarantee it. Most tax professionals do not know this stuff, okay, because they're just too busy cranking through tax returns. Okay, but let's start from the top here. I'm going to expect a very basic understanding here, okay, and my apologies if this is too basic, but I really want to make this so easy for people to understand. Okay, if you have a business and you have employees, you probably know, or at least you should know, that you need to collect certain taxes from those employees' paychecks and remit them to the government. Okay? Now, the taxes, at least for federal purposes, that you take out of your employees' paychecks and send to the government are federal income taxes. They are Social Security taxes, at least half of the Social Security taxes, right? Because you, the employer, are responsible for the other half, but half of the Social Security taxes your employees have to pay out of their own pocket, out of their own paycheck. And same thing with Medicare taxes, right? Half the Medicare taxes, the employees share. Okay. Now, there are other payroll taxes too that you, the employer, have to pay out of your own pocket. They aren't deducted from your employees' wages, right? FUTA, okay, that's the federal unemployment, and then the employer's share of Social Security and Medicare. There's state stuff too, right? State contributions to the state unemployment insurance, right, tax and all that the employer pays. I'm not talking about state stuff here because the trust fund recovery penalty is a federal thing. Okay, are all of these taxes, all those payroll taxes, subject to the trust fund recovery penalty? The answer is no. It's only the ones that you, the employer, hold in trust. And which ones are those? Those are the ones that you take out of your employee's paycheck. Okay, your employee earned this money. They earned this much money. You took out all this withholding from their paycheck, federal income tax withholding, their share of Social Security, their share of Medicare. Okay, you as the employer are responsible to hold that in trust and then remit it to the federal government. Okay, those taxes there, the federal income tax withholding, the employee's share of Social Security, employee's share of Medicare, those are the trust fund taxes. Those are the taxes the trust fund recovery penalty are assessed for. Okay, so keep that in mind, right? That money is not your money; it's your employee's money that then is supposed to become the government's money when you remit it to the government. Okay, but as your employer required to collect the money and remit it, that's why it's considered to be in trust. That's why these are trust fund taxes, and the IRS takes it very seriously if these taxes are not remitted to them. Okay. The IRS essentially views this as stealing from the federal government, not once but twice. And if you think about it, it makes sense. Okay, let's say that you withhold, I don't know, for an employee, $10,000 of federal income tax withholding from their paycheck during the year. But let's say, you've been having trouble paying your vendors, and so instead of paying those taxes to the government, you use it to pay your vendors, right, to keep the business afloat. Well, the government views itself as being stolen from twice. Why? Well, it views itself as being stolen from first because that's $10,000 in your bank account, or that you paid to somebody else that should have been in the United States bank accounts, right? Treasury, right, for the federal income tax withholding. The IRS or the government views itself as stolen from a second time because when your employee goes through their tax return, they're still getting credit for that $10,000 of federal income tax withholding that you took out of their paycheck. They're still getting credit for it on their tax return. So not only does the IRS or does the government not have the money in its bank accounts, right? But it also has to give the taxpayer, your employee, when they file their return, credit for that income tax withholding when the employee files their tax return, right? And pay them a refund, right? If they're owed a refund and all that. So that's why the government takes these trust fund taxes very seriously. Okay. And because they take it so seriously, the government, the IRS, is allowed to assess this trust fund recovery penalty personally against those individuals whom it considers to be responsible persons. We'll talk about more what that is, who the government believes have willfully failed to collect or remit these payroll taxes to the government. Okay. Now, although it's the same amount, right, the trust fund recovery penalty is different than the unpaid trust fund obligations of the business itself, right? Because the trust fund recovery penalty is assessed against individuals. Okay, and this is why it can be such a nightmare. Okay, because let's say you have a business and you didn't pay the corporate. You'll say the corporation, you didn't pay the corporate income taxes. You didn't pay FUTA. You didn't pay your share of your employees' Social Security and Medicare taxes, and you didn't pay all the trust fund taxes either. Okay. So basically not a sustainable business, right? Because if a business can't make payroll consistently and can't pay its payroll taxes consistently, probably not a sustainable business. And let's say, okay, the business, you figure that out, the business goes out of business, winds down. All of the corporation's obligations die with the business. And you might think that, well, I'm glad that's behind me because now I can go scot-free, do something else, not have to worry about all those unpaid corporate taxes. And that's generally true for the income taxes. Okay, I mean, there's some exceptions, right? But that's generally true with the income taxes and the non-trust fund payroll taxes, right? But the trust fund recovery penalty makes it so the government can cause those unpaid trust fund taxes, the employees, federal income tax withholding, employees' share of Social Security, employees' share of Medicare, that can follow you personally. The business can be gone, but your obligation for those trust fund taxes can live on personally. Individually, IRS can levy you. IRS can take your wages, levy your bank account, seize your home, take your stuff for the unpaid trust fund portion if it assesses the trust fund recovery penalty against you. That's why this can be so scary and daunting. In fact, the largest cases, by far the largest cases we have at Choice Tax Relief for payroll cases, and in particular trust fund recovery penalty cases, right? We haven't had an 8-figure client yet who had 8-figure of these, but we have had very high 7-figure obligations, trust fund obligations for some of our clients. And it's just huge, right? Because, let's say you have a small business and you employ a few people, let's say a dozen people, right? And you're squeaking out as the business owner maybe like $100, $200, maybe $300,000 a year, right? Because, all your costs go to all these employees, right? It's not like you're making millions, right? Your company might be grossing a lot of money, but as a business owner, and you know this if you're a business owner, you got your overhead, you got, marketing, you got all the stuff, right? But then the unpaid trust fund payroll taxes on these employees over years, several quarter years, it could be millions and millions of dollars, right? Far more than you would ever have the ability to repay. Oh, and not only that, the IRS isn't only going after you, the owner. They're going to go after the bookkeeper. They're going to go after the payroll person. They're going to try to make everybody a responsible person, right? And each one of them would be assessed this huge trust fund liability, right? Now, it can't collect more than the actual tax that was owed, right? So it's not like the IRS is getting like multiple back, okay? But still, every one of those responsible people are jointly and severally liable for the debt. So let's talk about this. Right, and so, well, okay, if we talk about what it is and what's the amount, well, the amount is basically the amount of the trust fund recovery penalty is the amount of the business's unpaid trust fund payroll taxes, right? Employees, federal income tax withholding, employee share Social Security, employee share Medicare. Okay, so we've talked about what is trust fund recovery penalty. Why is it called trust fund? We've talked about how much is the trust fund recovery penalty, and now let's talk about who can be assessed the trust fund recovery penalty. Who are these responsible? Who is a responsible person? Okay, because the IRS has said it can assess a trust fund recovery penalty against anyone whom it believes to be a responsible person. Okay, and that means responsible to collect, account for, and or remit trust fund taxes to the government, and who willfully failed to do so. Okay, both the responsibility and the willfulness must exist for someone to be a responsible person. Okay, and like I said previously, it can assess the trust fund recovery penalty against multiple people who then become jointly and severally liable for the tax debt in full. Okay, that means that each responsible party, each responsible person is personally liable for the entire debt. Of course, if the debt is paid off by one or multiple parties, then that settles the matter for everyone at that point. Okay, it's not like the IRS is going to collect more. Let's say there was $1 million of unpaid trust fund taxes. Yeah, all these responsible people, they're all liable for the $1 million, but it's not like, oh, the IRS is going to collect $1 million from that guy, $1 million from that guy, $1 million from her, $1 million from her. Now, once the whole $1 million has been paid, the trust fund recovery penalty goes away for all of them. This all said, the IRS has been known to be extremely aggressive when it comes to determining who is a responsible person for purposes of the trust fund recovery penalty. Okay, you don't necessarily need to own the business for the IRS to try to go after you as a responsible person. Okay, they've tried to go after. I'll give you some examples here in a bit. Basically, who is a responsible person? So the statute allows for an assessment of the trust fund recovery penalty against anybody who is required to collect, truthfully account for, and pay over a trust fund tax. This is what the IRS considers a responsible person for trust fund recovery purposes. Yes, this could be the owner of the company. Okay. But it could also be another individual with signature authority on the company accounts. It could be a company treasurer, controller, even a bookkeeper. Okay. In fact, let me pull up the IRS website. All right, so there's this page on the IRS website, and where it uses words like accounting for. Is this the one? Right. You don't necessarily have to be the owner of the company who it just says if you're a person responsible for withholding, accounting for, which is very clerical, or depositing or paying specified taxes, okay, including employment taxes. Right, and willfully fail to do so, blah, blah, blah. You can be personally liable for a penalty equal to the full amount of the unpaid trust fund tax plus interest. Okay? That's a trust fund recovery penalty. And then on another page, the IRS kind of gives this even longer list of folks who the IRS could consider to be a responsible person for purposes of the trust fund recovery penalty. Okay? Officer, employee, that makes sense. Right? Member, employee of a partnership, a corporate director, or shareholder. Oh, a shareholder, huh? Okay, yeah, that's kind of a part owner. But a director, right? They're probably a shareholder too, but they're not necessarily like a CFO or an employee, right? They're probably not. They may not be an employee, right? Member of a board of trustees, right? Another person with authority and control over funds to direct their disbursement. Another corporation, third-party payer, even payroll service providers. Okay, so they can go. Their definition of who can be a responsible person is extremely broad. Okay, extremely broad. Okay, that said, it's pretty well fleshed out in the case law on this. That in order for an individual to be considered responsible for these purposes, they must not have been merely acting at the direction of somebody else, right? Like a boss or superior. Okay. They must have exercised some degree of independent judgment, resulting in the trust fund taxes not being collected and or remitted. Okay. This does not necessarily mean that they have to have had final say or be the ultimate decision maker concerning whether the trust fund taxes were paid. Okay. But they must have had some power regarding whether or not the taxes were paid. Okay. And for trust fund recovery penalty cases at choice tax relief, sometimes or very often we fight the IRS and make arguments to the IRS why our client did not have the power to make these kinds of decisions, whether or not the payroll taxes were made. For example, maybe a company has a bookkeeper, right? And this bookkeeper accounts for, right, payroll taxes and other things. And maybe even the bookkeeper has signature authority on the company's bank accounts. Meaning the bookkeeper can write and sign company checks. It's a pretty bad fact pattern for a bookkeeper, right? When it comes to this stuff, knowing how aggressive the IRS is. And on that basis, the IRS may come in and say, oh, not only is the boss a responsible person here, and we can levy their personal bank accounts, garnish their wages, whatever. Oh, but also bookkeeper. Oh, were you on the bank account? Okay, you're responsible too. Now we can take your wages, levy your bank account, take your stuff to pay these unpaid trust fund taxes. Okay. But what if there's more nuance here? Okay. What if, the employee being on the corporate account and can sign the checks, that's really was just for the convenience of the boss, right? So he or she wouldn't have to, sign every check. What if it was just for his or her convenience, right? And in reality, the bookkeeper didn't actually have any say over which bills were paid or not, right? Let's say the bookkeeper, he or she would walk into the boss's office with a stack of checks and, the bookkeeper would have signed them all. But then the boss would have the final say and the bookkeeper had no input whatsoever and say, okay, pay that vendor. Oh, no, don't pay the payroll taxes. Let's hold off on that. Okay, pay that guy, pay me, obviously, right? But really the only person with any power here is the boss, right? The bookkeeper, even if they're on the bank account, they're just fulfilling a clerical function. Okay. In this kind of instance, we would and have argued that the bookkeeper didn't really have the power to make any decision regarding the payroll taxes. Okay. Sure, they may write and sign checks, but really they're just going to do what the boss tells them. They're simply fulfilling a clerical function, okay, without any real power to have made the decision whether the trust fund taxes were paid or not. Okay. So that's responsible, right? There has to be some power. They can't just merely be acting at the direction of a boss or other superior. Okay. They must have some influence on the decision. Now, in order for someone to be a responsible person, they must also have willfully failed to collect and or remit the payroll taxes to the government, right? So what does it mean to be willful? Now, the fact that an individual was a responsible person is not enough, okay, for the IRS to assess the trust fund recovery penalty against them. They might try, but really, they have to be able to show willfulness if they do that, okay, and oftentimes they can't. That's why we fight them about it. So what does it mean to be willful? Okay, in this context, it means that both of the following things are true. One, it means that the responsible person was aware or should have been aware, okay, of the outstanding trust fund taxes. And two, it means the responsible person either intentionally disregarded the requirement to remit the trust fund taxes or was merely indifferent to the requirement. Okay. An evil motive is not required. Okay. In fact, a business owner might think, well, gee, the right thing here is to pay my guys, to pay my contractors, okay? Because they need to put food on the table for their families. And if I don't pay them, their families are going to suffer and things will be very bad, okay? So a business owner might think, well, okay, I have the choice between paying my contractor or paying my payroll taxes. They might think the ethical thing to do is to pay their contractor because their contractors are living paycheck to paycheck and they need to put, food on the table for their kids. And they would think, oh, I'll catch up with Uncle Sam later, right? What's he got? Trillions, right? So I'll pay my guys now and the government later. Uncle Sam has enough money anyway. unfortunately, taking an action like this, where there was a clear knowledge, a clear willfulness to disregard this bill to the government for the trust fund taxes and pay this bill. Okay, that's willfulness, right? And it doesn't have to be that apparent, right? It's pretty obvious if you're a business owner and you don't pay the trust fund taxes that you willfully did not do so. Usually this comes more into play with folks who are not the business owner themselves. So now a common question that comes up at this point is, can a sole proprietor be assessed the trust fund recovery penalty? Okay, because if you think about it, this is I described the trust fund, the payroll, the trust fund taxes in the context of a corporation. Okay, but what if I'm a sole proprietor? Right? What happens to the payroll taxes? Right? Well, it depends if you have a single member LLC or not. Okay, if you have a single member LLC, then yes, you can be assessed the trust fund recovery penalty. Right? Just like a corporation, the LLC that's the LLC's obligation to pay those trust fund taxes. Right? If the LLC doesn't pay it, the IRS can't go after you personally, typically, unless it has assessed the trust fund recovery penalty against you. Okay. But if you don't have an LLC, okay, and it's just you're the payroll filer, there is no trust fund recovery penalty for you because you're already entirely on the hook for that entire payroll obligation personally, trust fund and non-trust fund. Okay. So that's the answer there. It's pretty simple. Okay, now let's talk about how the heck does the IRS even assess the trust fund recovery penalty? Okay, so once the IRS discovers that a company's trust fund taxes have not been paid in, it typically launches an investigation. Well, first of all, it's going to assign a revenue officer to try to work the payroll case, right? To get the business back in compliance with payroll, blah blah blah. Oftentimes it doesn't happen because the business just doesn't have the cash flow to survive while simultaneously paying its payroll taxes. Right. So, once a company's at this point, the IRS will typically launch an investigation into whom it can assess the trust fund recovery penalty. Okay. But how does the IRS even suspect in the first place that a company's trust fund taxes haven't been paid in? The process starts with an FTD, Federal Tax Deposit Alert. Okay. And this program, it identifies anomalies in employer's payroll tax deposit history. Okay, and looks at patterns to determine the employers who have missed their payroll tax deposit requirements and are at least likely to self-correct in the near future. All right, this analysis is typically done the 12th week of each quarter. These alerts are sent out to revenue officer groups the following week, so the 13th week of each quarter. So this process generally happens during the last month of the quarter. March for Q1, June for Q2, September for Q3, and December for Q4. Okay, so the revenue officer group manager gets these FTD alerts, which they're supposed to assign to a revenue officer in their group within 7 calendar days. Okay, and then once the revenue officer is assigned the alert, they're supposed to review the business's payroll history and contact the employer or their representative about their payroll issues, and even visit the place of business within 15 calendar days. All right. And sometimes the result is, right, after the revenue officer talks things over with the business owner or the representative, is that, there is an anomaly in the employer's payroll tax deposits because, maybe the business isn't actually liable for as much payroll taxes as they used to be. Maybe the business laid off a bunch of people. Maybe the business is very seasonal, right, which would explain the drop in payroll deposits. Okay, and in these cases, the revenue officer might close the FTD alert, right, with the closing code. But what if the business has really fallen behind on their payroll taxes, right? In this case, the revenue officer, like I said before, will attempt to compel, the business to get current and get caught up. And they'll usually talk about the penalties and interest and all that stuff, try to scare them into compliance. And then the business gets in compliance, files the required 941s, right, pays the payroll taxes, penalties, and interest owed, all is well, the case will be closed, okay? But if the business does not get in filing and payment compliance, the IRS may take collection activity against the business, okay, and even file SFR, substitute 941 returns for them, okay, for any unfiled payroll tax returns. And And that stuff, right? So now there's this payroll obligation for the business. Yes, the IRS could attempt to collect from the business, right? That's a conversation for a different video. Okay. Of course, something else the IRS can do at this point, which is the purpose of this video, is to assess the trust fund recovery penalty against responsible persons. Okay. And step one of this process, once the business has gotten behind its payroll tax obligations and the IRS wants to assess the trust fund recovery penalty, right, against individual people personally for the unpaid trust fund portion, the first step is by doing trust fund penalty interviews. Okay? Trust fund penalty interviews are either done in person or via the phone. And these interviews, the interviewer, generally the IRS revenue officer, asks the interviewee, right, who is suspected of possibly being a responsible person, questions from this little beauty right here. IRS Form 4180, report of interview with individual relative to trust fund recovery penalty or personal liability for excise taxes. Okay, and the purpose of this, and you can see some of these questions down here, right? And the purpose of this interview is to determine whether the person being interviewed is both responsible and willful for the unpaid trust fund taxes. Okay, so, and you kind of see the sections here, right? Responsibilities, right? What were your responsibilities in the business with respect to the payroll taxes? And then the section 4 or section 5, knowledge and willfulness, right? Because those are the two components here that the IRS has to that are necessary for someone to be assessed a trust fund recovery penalty: responsibility and willfulness. Okay. I'll probably go through this form in a different video. This video is already getting quite long. We're already 27 minutes in. But basically, if you're on the phone with the revenue officer and they're asking these questions, okay, you probably want to say stop. You're under no legal obligation to answer these questions, right? When the RO presents them to you, by the way. I would highly suggest, because this interview is very important, that you hire a professional representative, right? Could be House of Choice Tax Relief, 826-8000 Tax, give us a call. Could be someone else, right? But I would highly suggest you get competent representation if the IRS is targeting you for the trust fund recovery penalty, right? I would highly recommend that, because how you answer these questions, the phrasing you use, is extremely, extremely important. Okay. You don't just want to wing this. Okay. You do not want to wing the 4180 interview. But let's say you did kind of wing it and you kind of miffed it, and the IRS is like, oh yeah, this guy's a responsible person. What happens next? Well, what happens next is the IRS is going to send you a letter. It's called the letter 1153. Okay. And this is basically a letter saying that, hey, look, we think you're a responsible person, and we're proposing to assess against you the trust fund recovery penalty. Okay? If you agree with us, sign the form 2751. Do not do this unless you have extremely competent counsel representative telling you to do so. Okay? What I would suggest in most cases is that you appeal a decision, and you have to appeal within 60 days of the date of this letter. And this is a very important deadline, folks. There was a recent tax court case, Kazmi versus Commissioner, and when the IRS is a party to a suit in tax court, it's referred to as the commissioner, right, who's the head of the IRS. Anyway, and this Kazmi guy, it says in here he was a part-time bookkeeper. Where is this? Part-time hourly bookkeeper. Okay, no ownership interest. Name was not on any of the bank accounts. Did not have check signing authority for urgent care. Okay, right. And they did the 4180 interview. Okay, and he described himself as bookkeeper, and he said he took care of payroll. And then he indicated he did not determine financial policy. He did not authorize payments of bills or creditors, right? And he did not authorize payroll, okay? He said he was authorized to transmit returns and make deposits, that he was aware that withheld taxes had not been remitted, right? So that's a fact pattern against him, but it sounds like he doesn't have any power, right? And remember what I said before when it comes to responsibilities, there has to be an element of power here. I don't think a part-time hourly bookkeeper has the power, okay, to make the decision whether the payroll taxes are paid or not, okay? Nevertheless, the revenue officer did recommend that the trust fund recovery penalty be assessed against Mr. Kazmi, okay, and they sent him the letter, right? The letter I talked about, the letter 1153. That's the one I just talked about here, giving a 60-day deadline to appeal the proposed assessment, okay, because it's not assessed yet until after these 60 days, okay. But Mr. Kazmi did not return or did not protest the proposed assessment within the 60 days. Just kind of, I'm not going to go through this whole case, but just kind of reading it in more detail, it seems like he wasn't a responsible person. But because he didn't protest the assessment within the allotted time, the 60 days, the IRS made the assessment against Mr. Kazmi. Okay. We're already over half an hour into this, so I kind of want to wrap it up. I mean, there's a lot we could say about this and that and the other thing. But okay, basically, if the IRS is proposing to assess a trust fund recovery penalty against you, be very wary when doing the 41A interview with the revenue officer. I would recommend you get representation and counsel to guide you there. If the IRS does propose an assessment of the trust fund recovery penalty against you, and you think there are any fact patterns whatsoever in your favor why you shouldn't be assessed it, appeal within 60 days. Okay, but now what if you're responsible? You're a responsible person. It's clear, right? What do? Okay, you have this huge liability assessed against you, the trust fund recovery penalty. What do? Well, there's a couple preliminary things you can do that are specifically with respect to the trust fund recovery penalty. For example, you can request from the IRS the names of other responsible persons, as well as information from the IRS as to what the IRS has done to attempt to collect the trust fund recovery penalty from these individuals. This is your statutory right to do this, by the way. And you could kind of talk to them and say, hey, let's all kind of pitch in here, right? This is if it's probably for some very small amount, okay, that you're liable for, okay? Because the IRS doesn't care who they get the money from, right? They get it from you or Jim Bob or Jane, right? They don't care, okay? You care, though. You don't, because you don't want to pay the whole thing, right? And Jim Bob doesn't want to have to pay the whole thing, and Jane doesn't want to have to pay the whole thing because everyone else fell at the face of the earth, okay? Might be a good idea to talk to them, right? See, hey, can we tackle this? Maybe we'll all, pay a third of it or something, whatever, a fifth of it. Again, this is assuming it's a smaller amount, okay? That's fairly manageable. Well, what if it's a large amount? Hundreds of thousands, millions, multi-millions of dollars. Well, in this case, you have to, with our clients, we treat it like any other collections case. Same tax relief options that are available for your 1040 income tax debt are available to you for the trust fund recovery penalty. I'll go through them here. I've talked about them extensively in other videos, including the one that you can watch by clicking the link at the top of the screen or in the description below. One is an offering compromise. IRS, taxpayer is never going to have the wherewithal to pay off $5.2 million of trust fund recovery penalty. Taxpayer has lost his business. He is now working a standard W-2 job and can barely afford to put a roof over his head for his family, which includes 3 dependents. Therefore, his monthly disposable income is this. He has a little bit of, money set aside that he's, willing to include in this offer. And that's that. Right? So it's a little more complicated than this. The math is not that easy. I've created my whole video on the offer and compromise formula and guidelines, link at the top of the screen and the description below. Offer compromise. It could be a partial payment installment agreement. IRS, taxpayer is never going to be able to pay this off. Okay. Taxpayer is willing to pay you some amount of their disposable income every month, but it's going to result in paying only a fraction of what is owed. That's partial payment installment agreement. It could be C and C, currently not collectible. The taxpayer can really afford to pay nothing to the government. Okay, these are the basic, standard, typical tax relief options. I've talked about them in other videos. There's a link to a video in the description below going over all of them. Okay, and I have also the individual videos on these tax relief options all over my channel. So I'm not going to go in depth on them here because I've gone in depth of them elsewhere. Well, that's it, folks. That is your education on the trust fund recovery penalty. I hope you enjoyed it. I hope you got something from it. I hope if you are in this position that you take hope. Know that there are solutions, there are way outs. Whether to just contest the trust fund recovery penalty and just say, hey, prove to the IRS that you're not responsible, prove to an appeals officer you're not responsible. Or if you are responsible, there are ways to mitigate that, right? And make it so you don't have to pay them all this huge sum, right? There are tax relief options available. If you'd like to talk to us at Choice Tax Relief, give us a call, 866-8000-TAX. Visit our website. You can fill out the form here. We'll reach out to you. You can click free consultation and book a time on the calendar. So, anyway, folks, thanks for watching. I have some other tax relief videos over here on the left-hand side of the screen. I'll see you in the next video. Bye-bye.